All right, Bulls and Bears, we're back with another dose of economic reality. It's Tuesday. It's at August 13th. So tomorrow, August 14th, which is Wednesday, we'll have the inflation data for July. And keep in mind, it was 3% in June. That's a year over year number. And let's start with that. I got a lot of other news to get caught up on today, but let's start right here with this chart of CPI. This goes all the way back to 2004, folks. This is a 20-year chart. And let's zoom in a little bit here. And what do we see here? We see since the huge spike up to 9.1%, which was the peak in looked like the summer of 2022, inflation has cooled. But look, it's in the 3% range still. Now I'll go all the way back to 2008, coming out of the financial crisis. We only got above 3% for a brief period. That was in 2011. And since then, we were consistently under 3%. A couple times it approached 2.9%, 2.3, but all the way back since a year now, since June, over a year, since June 2023, we've been at or above 3%. And that's supposed to be good, even though that's higher than pretty much the entirety since we come out of the financial crisis all the way up to 2020. But that's supposed to be good news. So there you go, cooling inflation, folks. And you know that the narrative changed as far as the inflation target. It used to be an average of 2%. That was supposed to be the target, an average of 2%, meaning if we had 2 years of 4% to average it out, it would be okay to have 2 years at 1%. That would average 2%, right? No longer the case. Even though we had 9%, 8%, going back to that chart, 7%, it's been averaging a lot, but we're not talking about deflation in order to average it out or average it down to 2%. You notice how that whole average inflation just went out the window. They forgot all about it because they don't want deflation. Because what happens? People let me know. I think you know. We've talked about this many times. Deflation unveils the truth that the growth that we've been talking about, the economic growth, is all just debt. It's people borrowing money, spending money they don't have, taking out loans. You guys know this, right? Let's move on, though. We've got some other news to get into. It'll be interesting to find out, though, what the CPI is going to come in at on Wednesday. And remember, that's numbers way too low. If you look at the entire basket of what most people have to pay for, we're still up about 10% year over year. So I think it's about the official numbers, I think, are about 1/3 of the real numbers, approximately. Americans' refusal to keep paying higher prices may be leading or maybe dealing a final blow to U.S. inflation spike. Well, we'll see. So if Americans refuse to pay for something, then we'll see deflation. Or if enough people refuse to pay for something, we'll see deflation. That's how it works. You have to have enough people willing to not pay these prices. The problem is a lot of people have to pay for these things. If you have a mortgage, you better pay for home insurance. Otherwise, your mortgage company is going to stick you with insurance. It's going to probably cost more than private market insurance. So you've got to buy insurance if you have a mortgage. Your bank or the lender for your home, they're not going to want you to go without insurance because they'll be on the hook for the loss if you can't pay for it or if you can't pay for the damage. So a lot of these things, and that's just one example, a lot of things you have to buy. You have to register your car if you want to legally drive. Now you can drive illegally, and then hopefully we won't see you on one of those cop videos where you try to fight the cop or something like that and do something crazy. A lot of things people have to buy, folks. Food, you have to buy it. People are looking for cheaper options. They've already downsized or they've already downgraded a lot of shopping and clothing, right? The people that used to shop at Macy's, they're now looking for clothes at Walmart and Target, right? So you have to buy certain things. Can you buy cheaper things? Absolutely. You can go to the thrift store. You probably won't find your size. Don't you hate that when you're at the thrift store, find something you're like, oh, it's not my size, darn it. Folks, this article out of AP, though, Americans' refusal to keep paying higher prices may be dealing a final blow to U.S. inflation spike. Well, it's still high. It's still 3%. Again, higher than over the past 10 years, or from the 10 years rather, coming out of the financial crisis. Let's just say from 2010 to 2020, we only hit 3% once during that entire 10 years. Now we've been at or above 3% for years. And this is supposed to be good news, and the U.S. consumer's in good shape here. Out of this article here, the great inflation spike of the past 3 years is nearly spent. Some America's largest companies, from Amazon to Disney to Yum Brands, say their customers are increasingly seeking cheaper alternative products and services. Yeah, because people are getting close to being maxed out or are maxed out on their credit cards. Those are 1 in 5 credit cards. All right, let's move on here. Wall Street Journal, talking about inflation here. Childcare, rent, insurance, where inflation hits the hardest, folks. Another article that backs it up, way above 3%. And you can just look at your own budget. You can just look at your friends, relatives, what they're paying for things. 3% is nowhere near it. But again, we'll see how the number comes out tomorrow, because even though we're looking at the number, we're comparing it to previous numbers. Even though the numbers are way too low, it still can give you a trend, because the numbers reported 5 years ago were too low also. So we still look at it compared to previous numbers. It'll give you a good trend here. Household spending expectations plunged to lowest level since 2021. Isn't that interesting? So why would people expect to pay less, or why would they expect to shop less, if the economy is so strong and the consumers are resilient? In July of this year, the household finance landscape reveals significant insights and changes in consumer expectations that could shape financial decisions across the country. The latest survey of consumer expectations, conducted by Fed Bank of New York, provides a glimpse into the financial outlook of households. Current economic climate, a snapshot. The median home price growth expectations remain steady at 3%. So people are still expecting home prices to go up even more, even though we're at record unaffordability, worse than the peak of the 2008 housing bubble. People look back at that bubble. They did look back at the bubble, and they used to think that it was a bubble. Now people are saying, was that even a bubble back then? Did the bubble even have to bust back then? It actually didn't, right? If they would have did back then what they're doing now, the bubble would have just kept growing. 2008, 2009, 2010, and beyond, we would not have seen a housing market correction if they did back then what they're doing today. Most of you know what it is. We cover it here several times. Zero reserve requirement for the bank, for all the banks. The banks don't have to have any money, and they can still loan out endless amounts of money. Sounds crazy, but it's true. Government buying most of the mortgages, that wasn't a thing back then. It was a thing, but it wasn't a thing like it is now. Now the government buys about 80% of these mortgages issued by non-bank lenders. By non-banks, we're talking about the Rocket mortgages, etc. And again, this bubble today, bigger than the bubble back then. It didn't have to go bust back then, but they found a lot of new ways to keep home prices elevated, didn't they? Down payment assistance programs today nationwide in every state. Down payment assistance programs, they're doing a lot to keep this bubble inflated. Foreclosures rise in China as homeowners struggle to repay mortgages. Another example that it's not just the U.S. People think it's a leadership problem here in the U.S. Yes, the leadership is a problem, but it's always been a problem. But it's not just that. It's the entire financial system, folks. It's happening in China as well. Homeowners struggle to repay mortgages. The number of foreclosed homes on the market in China rose more than 12% year over year. A total of 202,000 foreclosed homes were listed for sale in the first 6 months of this year. Now, that's not a lot compared to the population of that country. But think about this. What I read here recently was that China has about 60-something million vacant homes in what they call ghost cities. Right? They built like crazy all this infrastructure. So if you have all those vacant homes, it seems like prices would crash, right? What about the supply and the demand? So why are people losing their homes to foreclosure when you have 65 million vacant homes? Are they not dropping the prices enough to get people into these homes? Right? Well, some of these ghost cities, and we talked about it here on this channel, Some of these ghost cities don't have anything in them. There's buildings and buildings and skyscrapers of condos and townhomes, but you don't have a grocery store for many, many miles. You don't have a lot of things that you need. No jobs for many, many miles. It's just apartments everywhere. It's crazy. So it's interesting that you have that many vacant homes, right? Because we're always told that it's supply versus demand, supply versus demand. Well, here's a country we have 60 something million empty, vacant homes, condos, townhomes, etc. Too much supply, but yet people are still getting foreclosed, right? Go figure that one out. It's insane, folks. Credit card and auto delinquencies surge in second quarter. That one's out of Mishtalk. We already talked about that, but they give us some nice charts in here. And it's interesting when you look at these delinquencies. Let's just look here at credit card delinquencies. Let's bring up one of the charts here. We see it spiking now. And if we look back, it hasn't been this high since about 2011. And when it first hit this number, was going into the financial crisis, 2007, 2008. And the steepness of this spike here, it's actually almost as bad as it was back then going into the financial crisis. So another example, folks, looking at the chart here, how things are headed in the wrong direction. And we're going to see how it all plays out here. Let's move on to some other news. There's a lot of things I wanted to get caught up on today. Last report, we talked about a possibility that several of the BRICS nations are all going to get together and dump U.S. holdings, U.S. debt, treasuries, etc. Dump them all at once for I believe we called that a sneak attack in our last report. But think about this. These countries are expanding all the time. In fact, there's some recent news that came out that other countries are going to get admitted into the BRICS alliance. 2 new countries get invited to attend BRICS 2024 summit. So it continues to grow. More than 45 countries have expressed their interest in joining BRICS in 2024. Out of the 45, 30 nations formally sent in their applications, and around 15 have informally expressed their interest in joining. Now, what I was going to do is add up the total debt held by these BRICS nations, because that would give us the severity of what would happen, or it would tell us the severity of what would happen if all those nations got together at once. And let's say in the middle of the night, they all dumped U.S. debt holdings at once together because they're an alliance, BRICS nations. So we'll have to gather all the countries that are in it now, plus the ones that are joining. So it's going to be very difficult to get the number, but just a few of the countries are already at $1 trillion. So could that affect the debt? There's people out there saying, yeah, that's going to be the blow to the U.S. dollar, to end the dollar, or to hurt the dollar so much where you see hyperinflation. There's people out there that say that. There's other people out there that say it's a nothing burger. They say the Fed can just come in and buy whatever these other countries decide to dump. And you have to look at both sides and say they're both possible. Anyone thinks the Fed can't buy it, well, you need to ask yourself why. Because they bought everything else. Look at the debt we have now. You just borrow it, or borrow the money from the Fed rather, and that's the 35 something trillion dollar debt we have right now. So why not add on another 35 trillion? So a few trillion dumped by a few of these countries, these BRICS countries, big deal, right? If the Fed can just buy another 10, 20, 30 trillion, whatever it takes, right? That's what some people are saying. And that's why I've always said here, you've got to see a rug pull on the entire banking sector. You've got to see a plug pull, like pulling the plug out of the printer, so to speak, or pulling the rug out from under something, flipping the card table over, right? So you have to see something massive to disrupt the entire system. And just from what I've seen, I don't think the BRICS countries dumping a bunch of debt is going to be the end of the dollar. I just don't think it is. I think there's too many other ways to prop it up. Just like we were the only channel ever since 2020 when everybody said the housing market was going to crash. We were the only channel that said it wasn't going to crash. The only channel that I know of. I mean, please let me know if you know someone else that has been saying it like I had. And I got a lot of backlash for saying that. People said, "Are you crazy? Are you crazy? Home prices are way too high. Nobody can afford homes. How is the home market or the housing market not going to crash?" People actually told me that. Several emails, hostile people telling me how wrong I was. And a lot of them I don't see here on this channel anymore. But all the things we talk about here quite often, the ways they're keeping markets inflated, right? They don't want deflation. They want more inflation. They're going to inflate to infinity unless the plug gets pulled out from the system here, from this mechanism. Let's move on here. U.S. U.S. credit card holders are addicted to spending. Huh, financial experts said that. Oh, you think so, huh? Addicted to spending? No, not Americans. Americans like to spend, especially when it comes to putting purchases on credit cards. A new study finds that 50% of Americans are carrying a higher month-to-month credit card balance than in previous years. It's a classic Peter and Paul situation. So they're robbing Peter to pay Paul. They're doing balance transfers. We've spoken about that here. What we're finding is more people now are carrying this debt month to month. Around 50% of people carrying debt from month to month, meaning not paying it off in full. Folks, with the rates 20% plus, isn't it amazing how there's not more people defaulting? Now, defaults are rising, but looking at the rates and the amount of people not paying off their card in full each month, it's pretty amazing that things have held together this long. Continues here. Credit cards can serve as a powerful tool, but they also present risks to achieving your financial freedom. Yeah, that's true. At least 50% of Americans are carrying higher balances today on a month-to-month basis. This is up from just 44% recorded in January. So it's spiked a lot just since January. So in a little more than 6 months, it went from 44% to 50%. How much longer, folks, until the rubber hits the road, until we see this default tsunami? And then also you have to wonder what type of rescue programs are going to be put in. Will it be like the housing market where no one got foreclosed? Will it be like the student loan situation where they say, sorry, you just don't have to pay back your student loans. It's okay. You can't afford it. Will they do the same thing with credit cards, right? So you have a group of people out there that say that. They say that nothing's going to happen because there's just going to be some program coming in to stop the deflation, to stop the correction, to stop the economy from dropping. So they're just going to say, okay, whatever it takes, 80 million people, you don't have to pay your credit cards because this is a crisis. It's like the student loans, they don't have to be repaid, right? Or they're going to forgive them. That's the latest. They're just going to forgive them. So will we see massive credit card debt forgiveness because of a crisis? We'll have to see how it plays out, folks. You can't predict a manipulated economy. Prepare for anything, inflation, deflation, all the above, folks. I'm not saying what's going to happen. I'm just saying prepare for it all. Prepare for worst case scenario in both directions. 20,000 plus job cuts at Dell. Employee describes layoffs as a bit of a dumpster fire. Folks, everything is fine, even though Dell's laying off 20,000 plus people. Everything's fine, nothing to worry about. Everybody's out there buying new laptops, new computers, and it's all AI, right? The economy's strong. It's just all AI that's taking these jobs. It's AI building the laptops, building everything at Dell now. So I'm just joking about that, folks. It's more than AI. AI, I think, is being used as the cover to try to cover up all this. They're saying that all these layoffs, not because the economy's slowing down, not because the consumer has too much debt. It's AI. It's AI. Talk about being overhyped, right? A couple other things here, folks. Canadian consumer insolvencies saw one of the worst months ever. Worst months ever. More Canadian consumers are filing for insolvencies at levels not seen since the Great Recession. Folks, it's global. It's global. You have fiat currencies all over the world, and it's not going to change in November. If the left wins, if the right wins, there'll be people out there happy either way. Some happy people, some sad people. But in the end, it's going to be more debt, lower rates, rescue programs, cost of living gets worse. I can continue, folks. U.S. corporate bankruptcy filings surge. So another surge. We're on pace to beat last year, 2023, and 2023 was the worst since 2020. So we're on pace to beat 2020 and last year. And think about 2020. That was a shutdown year. So we're on pace this year for corporate bankruptcies to be worse than 2020. And 2020 was a shutdown slash lockdown year. Think about that, right? We're not shutting down now. We're not locking down now in 2024, but yet we're still going to have more corporate bankruptcies if the pace continues. And I think it will. I think it'll just accelerate, actually. U.S. officials are heading to China amid rising tensions. Well, yeah, China is one of the BRICS nations, right? So we've got Yellen out there. She's going to go to China and she's going to straighten everything out. She's going to dazzle them with their scarves. Yeah, scarf. And she's going to work everything out. It's going to be fine. China's going to be, our friend, and it's going to be all good. Nothing to worry about. Janet's got it, folks. Please let me know what you think about that one down in the comments. Oh, back up to Canada. Sorry, I should have tied in with this. I should have tied this in with the other Canadian story here. Toronto Star: more than 300 Canadians are filing for bankruptcy each day as insolvency filings hit 4-year high. But no, inflation's cooling. Everything's getting better. Folks, everything's getting better if inflation's cooling. Why are all these data points pointing the opposite direction, pointing to people having more difficult time, people cutting back on their spending? One, because they have to, because their credit limits are close to the edge or close to the limits. And the other, because they're just freaking out because they can't pay off their debt, so they're spending less. And then you have articles out there like this: housing affordability is moving in the right direction, economists say. So to me, this kind of looks like the narrative with inflation. Inflation's moving in the right direction. Even though it's still going up, we're still up 3% year over year if you look at the fake government data. Moving in the right direction, though. Home buyer affordability conditions are beginning to improve. Experts say mortgage application payments decreased to $2,167 in June. It declined from $2,219 in May. That's barely going to be noticeable. You have this picture of this couple right here. Bring this up here. And they are celebrating. They've got the fist in the air because they bought a home. What they don't tell you is after this picture was taken, they both had to run to work. Him to his second job and her to her gig slash side hustle job to pay for the mortgage and all the insurance costs and the upkeep and maintenance on that home behind them, which is a very small home, by the way. Anyways, folks, hope you're good. Let me know what you think about all this down in comments. What did we start with today? We talked about the CPI number. We'll see you tomorrow on that one. Please make sure you subscribe. Very important time to stay ahead of the financial curve. Talk to everybody very soon. Keep stacking. Bye for now. Peace.